Well, for a closer look at the wider implications of the budget update, I spoke to David Simmonds, Royal Bank of Scotland's Global Head of Research and Strategy. David Simmonds, welcome to Late Line Business.
Thank you.
Well, pretty minimal change to the MyOFO, really. We're still on track for a $3 billion plus budget surplus by 2012-13. Almost seems too good to be true.
Maybe so, in the longer run scheme of things, and that really involves a discussion around the sort of broader picture risks to the China economy in particular, to the commodity story, and of course the whole massive positive shock to Australia's terms of trade. So that always warrants scrutiny. It always warrants a lack of complacency. But that, I think, is more a sort of multi-quarter or next couple of years kind of discussion.
Yes, we've got the US doing quantitative easing, and we've got emerging markets and those countries like Australia who depend upon them doing effectively quantitative tightening. Now, how long do you see that this must continue?
Well, it can't. It can't continue is the answer. Asia macro policy needs to tighten. Some or much of that tightening needs to be through monetary policy. And this is the risk for the Asia region at this point. Policy is in the wrong place for a number of these economies. Interest rates will need to rise. And in the meantime, we'll have to watch the risks of unwise rates of property price appreciation, unwise levels of bank lending in China, for example, and also the risk that we get some kind of inflation event or accident somewhere along the track. These are live risks, I think, at this point.
Do you see a clear uncoupling of Australia from the US now? And indeed, how much of an uncoupling can there really be when everything we sell to China is in US dollars?
Yeah, again, it depends on perspective here. I must say I'm not a long-run decoupling sort of person at all. I think, for example, the US and China are two sides of a global economic seesaw. You've got a US Federal Reserve obsessed with avoiding a kind of Japan lost decade kind of experience, hyperactive monetary policy, try and kickstart consumer demand, get the consumer going, get the US importing more. Dollar should fall against currencies of countries, racking up growing surpluses on the other side of the re-widening US deficit. Meets a lot of yet more intervention to stop currencies going up or going up too quickly, yet more massive foreign exchange reserves growth, and this kind of recycling of surplus savings from Asia to the US. But from a more cyclical perspective, it clearly is deeply advantageous for the Australian economy, experiencing such a positive terms of trade shock, whose near-term cyclical fortunes are so closely or inextricably linked to China.
We've got Robert Zoellick, the World Bank chief, saying this week that there has to be some sort of relationship between a country's currency and gold. Gold is now over $1,400 an ounce. Can you see this sort of a realignment happening?
Well, let me approach that from a more sort of pragmatic markets chair, if you like. There is a relationship between currencies and gold at the moment, which is gold is going up because you can't print it. Gold is going up because the US Federal Reserve is printing dollars. And gold is going up because there are still concerns that some other central banks may yet be drawn into printing fiat currency as well. So there's this sort of lack of faith in fiat currency equates to increased faith in stuff that you can't print or create out of thin air, and gold is prominent among those, is favourite among those things. So that's the relationship at the moment as far as I can see.
You mentioned the possibility of an inflation spike somewhere being a real risk. Well, Australia's unemployment rate is now forecast to fall to 4.5% by June 2012. The government has raised its CPI forecast to 3% in 2011-12. What sort of impact will the very low unemployment figures have on inflation?
Yeah, there's actually an interim question to that, which is what kind of effect is falling unemployment closing output gaps or if you like, sort of tightening, the sort of tightening in the factors of production going to have on policy? And the answer, as far as we're concerned at RBS, is that will have quite a significant impact on policy in Australia, and that the cash rate's going up further. The cash rate is going to go up by more than markets currently discount. And that the cash rate's probably going to hit 6% in the foreseeable future. So, I think policy tightens, and clearly Reserve Bank of Australia will be tightening policy in an attempt, a very direct attempt, to preempt any risk that inflation rises and rises above target. So, rates are going up, policy is going to tighten further.
David Simmonds, I thank you very much for talking to Late Line Business.
Thank you very much.